Global Finance, Topic 12A, Measuring and Managing Transaction Exposure. Copyright Lou Gaddis. The objectives are to understand and recall the methods for measuring and managing transaction exposure, and to calculate transaction exposure or loss. To recall from last topic, there are three types of foreign exchange exposures. Translation exposure, which is simply accounting gains or losses as balance sheet items are revalued using new exchange rates. Translation exposures often lead to cash flow exposure. So an example would be if you had a Mexican subsidiary that had inventory in Mexico valued in peso and then translated to the US dollar in the US parent's financial statements, and if the peso devalues, you may have to show a loss in the parent's financial statements. A cash flow exposure is when that actual inventory is liquidated. If it is liquidated when the peso is devalued, then converted back to dollars, the parent company gets less dollars than they would have expected. Another type of cash flow exposure is competitive exposure, which we'll cover in the next topic. That is a long-term exposure to a currency. So again, just to reiterate, translation gains and losses may or may not lead to actual gains or losses. An example of one that will not is a US-based multinational that has a Mexican City storage facility under its long-term assets, quoted in dollars, in the US financial statements. And say every quarter, the peso per dollar exchange rate goes from 12 to 13 to 12 to 13 to 12 to 13. And depending on the translation method, they may have to report a gain, a loss, a gain, a loss, a gain, and a loss. However, if that facility is never sold, it never leads to any kind of cash flow gain or loss. In contrast to that, what if that same company had an inventory position in pesos, and the exchange rate goes up or down, there's a gain or loss, but when the actual inventory is sold, converted from pesos to dollars, and the peso was devalued at the time, then there could be a real loss. So translation losses become transaction losses when the asset is actually sold or comes due. So transaction exposure is the net position of assets and liabilities in foreign denominated accounts that are expected to come due. Not just reported, but actually come due. Here's a problem that's based on a British firm. So in this example, Rolls-Royce, a British jet engine manufacturer, sells engines to the US and buys parts from US companies. It has accounts receivable of $1.5 billion, accounts payable of $740 million, and it also has debt of $600 million. The current spot price of the pound is 150.128. So the first thing we can say, and let's assume that all these accounts are going to come due in the next few months. So we can calculate what is Rolls-Royce's dollar transaction exposure, again in dollar terms. Well, let's just take the accounts, the assets and liabilities, and so the actual cash flows for the company in, say, the next few months. And again, this would be specified that these accounts were coming due in the next few months. So their dollar exposure would be their net cash flow they expect to receive or pay. So I'll put everything in millions. So in this case, Rolls-Royce expects to receive a net of $160 million. So we say that their transaction exposure is $160 million, or they're long the dollar. Since they're a net receiver of dollar, their exposure is to a devaluation of the dollar. So thinking about that, when all these accounts come due, they're a net receiver of $160 million. If dollars are worth less in pounds and they go to sell them at the time, they'll get less pounds in exchange. However, we have to be careful with this problem because this problem states the value of the dollar in indirect terms for a British citizen, direct for an American. So the exchange rate was 151 when they say recorded these transactions, and when they come due, the pound appreciates to 176 from 151. So we're going to calculate Rolls-Royce's transaction gain or loss. Now for all gains and losses, we're going to use the same formula. The gain or loss is going to be the value of their position times the new minus old exchange rate. And in this case, the value of the position is $160 million. Now most of the problems I'm going to give you are US-based firms where the exposure is in foreign currency units, say euros. But this is one of the unique problems where it's a British firm looking at its dollar exposure. Now we just take the new minus old exchange rate. Now you have to be careful here that if this is in dollars and we want the answer to be in pounds for a British firm, we need a pound per dollar exchange rate. So the new pound per dollar exchange rate is that, the old 51.28. That will give us a loss of 15 million pounds, or give Rolls-Royce a loss of 15 million pounds. What's helpful in these problems is always guess the sign before you start. In this case, they are long the dollar. They're a net receiver of dollars. Then look, see what happened to that currency. So if they're long the dollar, what happened to the dollar? Well, in this case, the pound appreciated, so the dollar went down. So they're a net receiver or long the dollar goes down, they must have shown a loss. So we knew it couldn't have been C or D. The only other way this problem could be more difficult is what if the math worked out that they were short 160 million. So if you came out here and you said, oh, I'm a net payer of 160 million, well, we would just make this short. Same formula, except my V is now a short position. Take new minus old exchange rate, and what you'd see is the answer would be 15 million. So how do you manage translation and transaction exposure? Well, from the last topic, we showed that one way of handling translation exposure is just to get foreign exchange assets to offset foreign exchange liabilities. So if you have a Mexican sub and you know you have a lot of peso assets and you're going to bill your vendors over there, bill them in dollars, so then you have peso liabilities. Likewise, what you want to do is if you're going to, say, start a business over there or continue the growth of a business in Mexico, finance that business with debt. Denominate it in the local currency. So if I'm going to finance the growth of a new building in Mexico City, I'll borrow pesos. So think about what that does. It creates a balance sheet item with a liability in pesos to offset the purchase of an asset and also your cash flows. Secondly, you create interest expense in pesos. So as the firm is generating profits, revenues and profits in pesos, it also has interest payments in pesos, again reducing the exchange rate risk. Another strategy would be to increase hard currency assets and increase soft currency liabilities. Hard currencies are currencies that are expected to appreciate or hold their value. Soft currencies are expected to depreciate. So if we're going to get a receivable in a currency, and you have a choice to bill them in, say, the dollar or the other currency, I would prefer to have an asset in a strong currency. So an example of a strong currency might be the Japanese yen, the Swiss franc. So these are currencies which are, say, generally expected to appreciate. So if I have a subsidiary over there, I would likely try to bill them in their currency. On the other hand, if you have, say, a Chilean subsidiary or just an account, and you are going to bill them for a sale, and you believe the peso is going to be weak over that time frame, I would bill them in pesos. Similar to this idea is price adjustment clauses. In this case, the actual bill of sale to, say, your Chilean counterparty, you would say, well, the price of the goods is going to be a million Chilean pesos. However, if the exchange rate falls out of a certain band, say plus or minus 5%, there'll be an adjustment to the price of the clause to make the firm whole. So in this case, it's kind of a price sharing or a risk sharing exercise where you can adjust the price up or down if the exchange rate goes outside the band. And then lastly, you use derivatives, primarily forward contracts and swaps, but also as futures and options to handle the rest of the exposure. So after doing all these things, you find you're still long the euro next year. You can then enter into a short forward to eliminate the remaining risk, or go to an exchange and get a short futures to get the risk, or enter into a swap. You can think of a swap as a series of forward contracts that are bundled together, or an option, in this case a put. So that's transaction exposure. So we learned about the methods for measuring and managing transaction exposure and how to calculate gains and losses. And the important thing to remember here is whenever you're calculating a gain or a loss, both for translation and transaction, the gain or loss is equal to the value of the position plus, if it's long, minus, if it's short, times the new minus old exchange rate. Being careful that if this currency is currency X, make sure the new minus old exchange rates are currency Y over currency X. So the X's cancel out and gives you a gain or loss in currency Y.